Welcome back to the Daily Crypto Deep Dive. The biggest mistake you can make right now in crypto is thinking this is just another price move. Because if you're only looking at Bitcoin at $70,000 and asking whether it's going up or down next, you're asking the wrong question entirely. The real question is why Bitcoin is moving at all, and more importantly, who is actually controlling that move. Because right now, it's not crypto. It's war, it's oil, and it's global money flows. So let's ask the uncomfortable questions that most people are avoiding. Is Bitcoin still an independent asset, or has it become just another macro trade? If oil spikes again tomorrow, does Bitcoin go down with it? If the Iran conflict escalates further, does crypto crash alongside global markets? And if that's true, then what exactly is the long-term bull case for crypto anymore? Because for years, the narrative has been simple. Bitcoin is separate. Bitcoin is decentralized. Bitcoin exists outside the system. But what we're seeing right now challenges that idea completely. When tensions around Iran escalated, Bitcoin didn't lead the move. It followed. Oil moved first. Markets reacted. And crypto was pulled into that reaction. So if Bitcoin is reacting to oil, and oil is reacting to war, then is Bitcoin really independent? Or is it simply sitting downstream of global macro events like everything else? And if that's the case, then why would institutions treat it any differently from stocks? Why would they allocate capital to Bitcoin instead of simply trading macro through equities, commodities, or bonds? That's the first uncomfortable question. The second is even more direct. If crypto drops every time there's uncertainty, how can it be considered a safe haven? Because that's what people want it to be. Digital gold, protection, a hedge against chaos. But in the early phase of this conflict, Bitcoin dropped hard. Liquidations were triggered. Traders de-risked aggressively. That's not what a safe haven does. That's what a high-risk asset does. So is the idea of Bitcoin as digital gold actually real, or is it just something that gets repeated when the market is going up? Then we get to the third question, and this is where things get serious. If oil continues to rise because of geopolitical tension, and inflation stays elevated as a result, central banks are forced to keep interest rates higher for longer. And if rates stay high, liquidity stays tight. And without liquidity, crypto does not run. That's the reality. So are we looking at a delayed bull market? Or are we looking at a completely different market structure where crypto is permanently tied to macro conditions? The fourth question flips the entire narrative. If global instability increases, does that hurt crypto, or does it actually accelerate adoption? Because when you zoom out and look at how people behave during times of uncertainty, they don't just sit still. They move capital. They look for control. They look for systems that can't be restricted or frozen. And increasingly, that system is crypto. So is war actually bearish? Or is it the exact scenario that proves why crypto exists in the first place? And then there's the final question, the one that ties everything together. If crypto is now reacting to macro forces, and macro is becoming more unstable, does that make crypto weaker, or does it make it more important? Because those are two very different outcomes. One suggests limitation. The other suggests expansion. And the answer to that question determines everything about where this market goes next. Now, when you step back and connect all of this, the structure becomes clear. In the short term, crypto behaves like a risk asset. Oil spikes, inflation fears rise, liquidity tightens, and crypto sells off. That's phase one. And if you stop your analysis there, the conclusion is simple. Bearish, unstable, not ready. But that's only half the picture. Because phase two is where things change. Once the immediate panic fades, markets don't just reset, they reposition. And this is where crypto begins to separate itself from traditional assets. Because unlike stocks, unlike banks, and unlike most financial systems, crypto doesn't close. It doesn't pause. It trades 24 hours a day globally without interruption. And during the early stages of this conflict, that mattered. Because when traditional markets were closed, crypto became the primary place where global risk was being priced in real time. Traders weren't waiting for markets to open. They were using Bitcoin, Ethereum, and stablecoins to react instantly to headlines. That's not just a feature. That's a structural advantage. And structural advantages don't disappear. They compound over time. At the same time, something else is happening beneath the surface. In regions directly affected by instability, crypto usage is increasing. People are not waiting for systems to stabilize. They are moving funds. They are protecting wealth. They are using Bitcoin and stablecoins as tools, not investments. And every time that happens, it reinforces the core use case of crypto in a way no marketing ever could. So now we come back to the original questions, but this time with answers. Is Bitcoin still independent? Not in the short term. It is clearly reacting to macro forces. But that doesn't weaken it. It positions it within the global financial system, which is exactly where institutional capital operates. Is Bitcoin a safe haven? Not in the immediate reaction phase. It behaves like a risk asset during panic. But in the stabilization phase, it begins to act like a hedge, and that transition is where the opportunity lies. Do high oil prices and inflation kill crypto? Short term, they create pressure. But longer term, they strengthen the case for alternative assets, especially ones that are decentralized and globally accessible. Does war hurt crypto? Initially, yes. But structurally, it accelerates adoption by proving the need for systems outside traditional control. And finally, does macro instability make crypto weaker or stronger? It makes it more important. Because in a world where traditional systems are under pressure, assets that can operate independently, globally, and continuously become more valuable, not less. And this is the shift that most people are missing. Now here's where it gets even more interesting, because some of the more aggressive macro analysts are starting to frame this situation very differently. There's a growing view that what we're seeing right now is not a threat to crypto. It's a transition phase. One desk described it as a stress test that Bitcoin is passing in real time, pointing out that despite the volatility, Bitcoin has held key levels and rebounded faster than most traditional risk assets. And their argument is simple. If Bitcoin can survive a geopolitical shock tied directly to oil, inflation, and global instability, then it starts to prove itself as a serious macro asset, not just a speculative one. Another analyst took it even further, suggesting that once this conflict stabilizes, we could see one of the strongest reallocations into crypto we've seen in years. Their reasoning is that elevated oil prices keep inflation expectations alive, and that forces investors to look for assets that can protect value outside of traditional systems. And in that environment, Bitcoin doesn't compete with stocks. It competes with gold. But here's the most aggressive take. One macro strategist described this exact setup as the final transition before acceleration, arguing that crypto is moving from a liquidity-driven market into a relevance-driven market. In other words, it's no longer just about how much money is in the system. It's about whether crypto has a real role to play when the system is under pressure. And if that's true, then the upside isn't just another cycle. It's a repricing. Because once institutions start treating Bitcoin as part of the macro landscape, not separate from it, the pool of capital that can flow into crypto expands massively. And that's the shift they believe is starting right now. They're focused on the first move, the drop, the volatility, the uncertainty, but they're not looking at what comes after. Because once oil stabilizes, once inflation expectations begin to ease, and once central banks regain flexibility, liquidity returns. And when liquidity returns, crypto doesn't just recover. It moves. That's the cycle. That's the setup. And right now, we are sitting right in the middle of it. So the real question isn't whether crypto is affected by this situation. It already is. The real question is whether you understand what that means for what comes next. Because the people who do are already positioning, and the people who don't will be reacting. Drop your thoughts in the comments, smash like, follow, and we will see you at the top.